I'm going to give you a little background on my story. My background's in physics and math, and went into geophysics for quite a while. I was in the oil patch for a while. But before that, during the Cold War, there was lots of money for research into how big the Soviet nukes were, and so I had a secret clearance, and I built models to tell Reagan how big the actual Soviet test site blasts were. And so I got into modeling that way. I built models through college and then in geophysics, and then after the Cold War we went into the oil business. So some of you that worked at, I'm told a lot of people worked at Exxon here, as it's a company town. And one of the products we sold to Exxon was a 3D modeling program called Quick, which we sold in the 80s. And it would simulate 3D field shoots. So you know when you go out and explore with the big trucks, and you set off explosions and look for where the oil might be. We could simulate all that in the computer. That was one of the first products I built for the oil business. And Halliburton then came in and bought up our company it was 93, and tried to move all our staff to Texas. Out of 350, they got 10. So a lot of the geoscientists stayed in Seattle. A lot of them started their own businesses like I did. And all of our programmers went to Microsoft. So poor Halliburton, they came back going, why doesn't anybody want to go to Texas? We don't get it. Anyway, so if you look back in the archives of Exxon, you probably would find our programs. Halliburton spun them off to Landmark, and then they bought Landmark, and now they operate them. So my background is in building models to help the government, help the oil industry, and then I spun into the financial modeling business. Now my job is to help managers like John do a better job managing your money, using the science applied to investing, which I wasn't sure could be done when I first started, but now it's proven itself many times over that that's the best way to go. So John said it'll be over your head. My goal is to not put it over your head. So I want you to raise your hand if I say something you want defined or you don't quite get it. Just do that. Just stop me. I take it as my personal, challenge to make sure that what I say is, as understandable as possible. And it's trouble for scientists, So we're going to talk about tonight is how we use modeling techniques to do a better job for your money here at JCN. So just a quick table of contents. We're going to talk about investment goals, which is simply making more money. And how do you buy an undervalued stock? You got to know what value is in order to buy something cheap. My wife loves to go into a store and buy stuff that's 40% off or more. Well, we'd love to do that too with investing if we knew what it really costs. We know what kind of a discount we could buy it at. And some of the tools that I used in the military business and in the 3D modeling of in the geophysics problems, I applied here. So we're going to make models that are really state of the art. And the other part of investing that we need to talk about tonight that you won't hear on CNBC much is the effect of the crowd. And the investment crowd can drive prices too far one direction or another. And in order to really understand how prices move on Wall Street, you have to talk about the crowd effect. So we're going to do that today and put it all together and show you what we're doing here at JCN. So without further ado, investment goals. We want, missing the first line. Our goal is to find stocks that are selling at a discount to value, that are likely to increase in value, and where there's a minimal amount of crowd effect and a fairly low volatility. Now, Alex, who you know, has put together a couple of slides that I've stuck in here. This is an interesting example. It just shows the dark blue line would be maybe the market volatility of a particular stock. And the light blue is perhaps what it's worth. Now this is just this was a real example? Or?
It's just an example of margin of safety.
Yeah, okay. So the idea is, you want to have a margin of safety. So we're looking to buy when you've got an undervalued situation, certainly here, but even here, and when the value's obviously above, but also climbing. So, that's what we're looking for. So we need to be able to measure what value is. And the question is how you do that. Now, I don't want you to all strain to read this. I'm just going to talk about how I approach the problem. As a scientist, coming to this the very first time, the first thing I did was, okay, who has written the book on investment? Who is the guru of the ages? And Graham and Dodd are the ones that wrote, the book that Warren Buffett uses, the book that is most used in the industry and most referred to is the Graham and Dodd Security Analysis book. Well, I looked through there and I found these two quotes, and it really directed all of my efforts over the last 25 years. And basically what he said was that we need to understand what value is, but more importantly, without some defined standards of value for judging whether securities are over or underpriced in the marketplace, the analyst is a potential victim of the tides of pessimism and euphoria which sweep the securities markets. So what that said to me was, we've got a problem that is best described in two parts. There's an intrinsic value, a fundamental value to a stock based on how the company's doing. A lot of you have worked for Exxon. If we take just the reported fundamentals from Exxon, we should be able to figure out what it's worth today. And then there's the effect of the crowd. So I split the problem into two pieces, a fundamental piece of value and a crowd effect. And we're going to talk about the fundamental model first. You all know about price-earnings ratios and, if a company doesn't earn any money, well, go back to 1999, right? The companies that didn't earn any money and had high burn rates were the ones that had high value. That's because of crowd effect. But normally, if a company is making money, they've got low debt, they've got sales, they've got some value in their assets, they're going to have an intrinsic value per share. Your shareholders are going to realize some value. Okay, so that's what I'm calling value-oriented behavior. Well, we'll get to the behavior aspect of it, but the fundamental side has real numbers under it. They report these numbers every quarter. Never mind what the analysts say about them. Never mind what the people get on CNBC and say, well, you got to look forward 2 years and then it'll be different. The real numbers is what we wanted. We wanted to say, okay, based on the real numbers, what's it worth today? And the reason I started down that road is I got a project from, it was Bankers Trust at the time. They wanted to know what IPOs would be worth when they went just before they went public. They said, we've got the fundamentals for the company. We know what industry it's in. What's it worth? So make a model and tell us. And that's what I built a model for. This was in 1989. And lo and behold, more often than not, the companies were being put out for an offering at a much higher price than their value. And you probably have all seen initial public offerings. It was like a sophisticated, well, I'm on camera, but it's a pump and dump scheme, The old school pump and dump where you pump up the value, you talk it up, you publicize it, and then it goes public at $40, but it's worth 20, and eventually it just sort of sags back down to its fair value. But of course they get paid. So I built this thing and they didn't really want it because it was telling them the truth of what it was worth, and they didn't like the truth. So we'll get into, so we're going to go there next. But the other part of this is crowd effect, and we're going to come back to this later. And this is a very emotional section. Okay, the fear of loss is an obvious one. Anybody who's had a stock that's gone down hard, has gotten a little scared. They're losing their money. You know, every day it's down a little bit more, and they're scared. So you might take action. You might call your broker and say, get me out of this. Fear of missing gains is also a fear. If your friends are all in Apple and it's been going to the moon and you're not in it, you might feel some fear of missing out. Chasing price is a crowd behavior. You know, it's been going up for weeks, so it's going to keep going up, so I'm going to chase it. I'm going to keep buying it. I'm going to get in there and buy it as it's going up. But the mainstay is ignoring what the value really is. And then ego gets in the way. You know, you bought the stock, so, you know, you usually make good decisions, so ego says, I'm not wrong most of the time, so it's got to be okay. And then you get a perception of value. A lot of times the news agencies, you know, like CNBC and all the business channels, they tend to highlight the go-go stocks. And they try to bring people on that will validate their pricing. I remember in the top in 2000, they had a guy that rolled out, said, oh yeah, we got a model that shows Amazon is worth exactly what it's trading at today. And of course, it cratered after 2000. So this is a real effect, and we can't manage money without acknowledging it and doing something with it. So now, in terms of building models, and we're going to go on the fundamental side first. So how many are still with me? Okay. So how many have seen Zillow before? Everybody nod? Okay, good. So this is a perfect example of what we call in the business a multi-factor model. There's lots of factors that go into valuing your house. You know, the zip code, you know, number of bedrooms, number of bathrooms, square footage, whether you got a pool, you know, what the taxes are, interest rates that are available at the time. All those things go into their model to decide what your house is worth, right? So they take all these factors in, they have a way of blending them into a model that produces a price. Well, how many have seen or know about FICO scores? Same thing. A number of factors blended together produce one number which represents your credit worthiness to the banks and lenders. So we've done the same thing. Oops. So this is a little picture of this isn't me, I borrowed it. Cobbled together this picture. All I'm doing is I'm taking the fundamental factors and I'm using a modeling tool which is marked as AI here. AI stands for artificial intelligence, and really all that is there's a mathematical function that you can put on your computer. I even run it out of Excel. You feed it examples of something you want it to learn about and tell it what the answer is. In this case, I feed it the fundamentals, actually for maybe 10 years worth of fundamentals and the price that existed at the time those fundamentals were published. And it learns how to map those fundamentals into that price. So it's a mathematical tool, that's all it is. I don't have to pay any unemployment insurance for it. I don't have to pay for an employment contract. It's just a computer program. So now, once it's trained, I can feed it additional data and it puts out a new stock price. You know? So I can feed it today's debt and interest rates and which industry and cash flow and book value and earnings, and it tells me what that stock's worth. So that's really simplified the game. Now most of the big houses don't do it this way. In fact, I've yet to find anybody that actually has attacked the problem this way. What they do is they say, well, we're going to sort first by price to earnings, and then the lowest price to earnings stocks, well, we'll take those and then we'll sort it by book value. And if there's any left over, we might sort it by cash flow. And then they come up with a very tiny list. These days it's probably very tiny. And they decide that relative to the rest of the universe of stocks, these few are attractive, more attractive than the others. Well, the problem with that is you don't have an absolute number. And sometimes the market gets very overvalued, so there's nothing to buy. And even if you're on a relative scale, and this stock looks better than that stock, they both drop. So it's better to have a good, consistent idea of what it's worth. And if all the stocks are overvalued, well, you don't buy much. So what I'm putting up on the right side is just basically what I use for modeling. We use what are called neural networks, which are just mathematical models in the computer. And the terminology is you train a neural network. You can train it to recognize characters on your phone. If you used to have those phones where you could write script and it would recognize the characters, those are neural networks that do that. You give it 100 examples of an A and tell it it's an A, it learns, and then next time you draw an A, it knows knows what it is. So that's all we're doing here. Been doing this since 1990, and it's a very useful tool. So, okay, so which factors are the most important? Well, back to Graham and Dodd. Graham said that book value and earnings were the most important factors. I just dug out one of his old formulas that just had book value and earnings as a way of estimating stock value. Well, look at this. This is the relative importance of all these different factors in stock price. Oh, lo and behold, Graham was right. It's book value and earnings that are most important. Although sales, cash flow, net income, short-term debt, et cetera, they're all important, but these are the most important. Okay, so now what? So we know what it's worth today. Here's an example of what Alex sees on his screen every day. He can bring up any stock and see what these little purple marks are, the valuations as they were reported when they were reported. And he can see what the valuations are. You can see I've been doing this a while. There's 1998, 99, 2000. And lo and behold, this is IBM, and oh, hey, it got overvalued. So do you want to buy it here? No. That's the point, is to avoid making this mistake. Because you can bet this rally here probably got everybody excited, and they probably thought it was going to the moon, but the value is down here. So, and that's the goal here, is to know when something's on sale and when it's not. This is just redundant information over here. And I pulled some of these slides from other shows, and there's some audio on some of them, so I'm just going to skip over that before it starts talking to you. All right. So this is a study I did, when did we do this? In 2004. And the idea here was to take every stock that was, the top 1,000 or so stocks, I believe, is what we used. We may have used even more. And just average what their one-year gains were over a period from 1989 through 2004. So that's a what is that, 15-year period. And the average return for all the stocks is about 9% a year, which is the long-term average for the stock market, by the way. I think for real estate it's about 4% over the last 100 years, and stocks it's about 9% return annually. Obviously it varies quite a bit, but so the question was simply, okay, so this model produces what the value of the stock is today. Well, that's not predictive. If I know what it's worth today, that doesn't tell me what it's going to be worth in a year, right? I didn't think this model was predictive. I thought I was building just an IPO model that would just tell me what the stock was worth today, never mind in the future. Well, as it turned out, the stocks that were undervalued by any amount, that's the pink line there, they went up. They went towards value. They moved. So basically I was sitting scratching my head going, wait a minute, I thought the market was efficient, that all information was factored in and new information was instantly priced. It isn't true. It isn't true. So what they teach in business school about the efficient market is, has to be modified a little bit to maybe the slow, efficient market. I don't know. But what happened here is that if you picked the set of stocks that were undervalued by any amount, even 0.5%, they did way better. I mean, this is 9% a year. This is 13% a year. I'd rather have 13% a year than 9. And then if you picked them that were 10% undervalued, well, you got almost 15, all the way up to being 200% undervalued. You double your return from 9% to 18%. So when I found this is a long time ago that I did this study and realized what I had. The money managers I was talking to all said, well, nobody beats the market, hardly anybody. If you can give me 3% over the market, I can raise a ton of money. This will be terrific. So what we did is we went to individual managers like John and offered this as an overlay to what they're currently doing for their clients and said, okay, well, do what you're doing now, but then also buy stocks that are undervalued according to this, and you should be able to do better. And that's really been our history. We've been a consulting company, and we've done one-on-one with managers over a number of years. Now this is available in software on Bloomberg and TradeStation. So we've now moved over. We do the consultancy, but we also have a software business that's doing well. So that's all well and fine. We want to outperform the market, but we also want to do it with less risk, because risk is, the problem for everybody. We don't, it's great to have gains, but if it comes at a price of huge drawdowns, huge swings downwards against you, then you can't sleep at night. So I put this slide together. This is basically a standard return versus risk diagram. So the return is your annual return. This is a period from about 14 years, from 2002 to 2015. So a good period for the market. I mean, like I said, the long-term gains are about 9% a year, and here we're getting a return of almost 17%. This is for the Russell 1000. So it's roughly the top 1,000 stocks in the US. And so this is if you bought the index, this green dot here. You get this much return with that much risk. This is risk along the bottom. So you want the risk to not be going up. You want the risk to stay low and the gains to go up. So you want to be in the green area as much as possible and not be down in the red area. Okay? So what are these lines? So the lines are what ifs. What if I picked the top 50% of the stocks using our valuation tool, well, and just held those. So I'm going to take the whole 1,000 stocks and divide it into two groups. I'm going to take the top half that are, just based on our valuations and hold those for the 13 and a half years. This is how you would do a little bit better, lower risk, and a little better performance. And if I take the top 30% of the stocks, well, my risk goes up a little bit, but I get lots more gain. I'm almost at 20% annual return. Take the top 20% of the stocks, well, I'm up to 22% return. But yeah, my risk has gone up a little bit. These methods are all the methods that everybody else uses. The green line down here is PE ratio. This is book value, price to book, price to cash flow, price to sales. All these other methods you'll hear the pros talking about. And they've talked about them for years. These are all very well known. We do better. So the idea is, let's find a measure for value, which we've done, that works as well or better than what's passing for valuation now on the street. Roll that out to managers so they can do a better job for their clients. And that's where you come in, where you all come in. This is just another of the same slides. Basically, we took the S&P 500 stocks and we applied our filter, the top 10%, and we did way better. The green line shows if you take the top 10% of the S&P, you outperform almost all the way through. So So that's a good value story. And here at JCN, Alex runs that every day. He's looking at your portfolios. When you came in the door, you probably had your portfolios valued, because he's been doing that lately. And so if you brought in stocks that were overvalued, he would probably, you were raising your hand and saying, that's gotta lose that one. I'm not sure of the process, but oh yeah, let's see, back. There we go. Stay. So just to reiterate, the scientific approach, this crowd effect and the fundamental value are the two portions we have to deal with. We dealt with value. We've got a good value tool. Crowd effect. Now this was where it gets a little dicey, where I lose people. Are you all with me so far? Anybody got a question up to here? Yeah, sure.
Two questions.
Sure.
When you say the program,
Yeah.
is that the same thing as algorithm?
Yes.
Okay, and when you talk about crowd effect,
Mm-hmm.
since we've had so much of the reporting pertaining to the stock market
Mm-hmm.
and all of the channels,
Yeah.
would you say that crowd effect has been enhanced?
Yes. The reporters are a part of the feedback cycle that we're going to talk about. They exacerbate the cycle. And the role they play, and you can't fault them. What they do is they go down on the floor and they ask around, what's going on today? What's the news? What should I report on? What's hot? What's going on? And the hotter the crowd is on a certain thing, the more the reporters will pick up on that item, because more people will be interested in hearing about it on the news, and they'll report it. So they are at the tail end of the crowd effect. They are the ones that sort of accelerate it at the tail. But we'll get into that. But everyone's a part of it, and all the investors really are participants in this crowd effect. And when I originally started dealing with this problem, I thought, well, what are we talking about? What's the behavior involved in fundamental investing versus crowd effect? Well, we're going to go to the next slide. Now I want you to, have some time to enjoy this one, because this is my crowd effect slide. So I've got a stock here that could really excel. Sell? This guy, I love this guy. He's like, sell? And then they panic. All right, same thing on the other side. Goodbye, buy? Okay, you get the idea. I couldn't think of a better crowd effect slide. This is just a classic. But I'm a scientist, so I gotta find a model for this. All right, so we're gonna talk about feedback. How many people know what feedback is? You ever put a microphone up to a speaker? Okay, that's not good feedback. We call that positive feedback. Where's an example of a negative feedback system? Anybody know? Some engineers in here, right?
Steering in the car.
Yeah, sure. Okay, there's one right over there on the wall. That is a negative feedback system, okay? When the temperature gets, I guess it's on cooling right now, so when it gets too hot in here, the air conditioner comes on, cools it down till it gets below a certain threshold, turns off, goes back up again, turns. So that's what I call value-oriented behavior. We want to see that in the markets too. If the stock price goes up too high, gets overvalued, investors stop buying, price comes down, gets undervalued, they get excited, they start bidding it up again. That's good. This is what it should look like. If we weren't human, it might look this way all the time. But we are human. And what us humans do is we imitate the crowd. We buy because it's going up. If it's going up fast, we buy more. And that gets the price going up faster, and then more people rush in to buy, and it goes up even faster. So what's an example? Well, I gave you an example, the microphone with the speaker. Anybody got another example of a positive feedback system? that they've run into? The guy earlier had a furnace system that he was talking about, where if you didn't do the right things, it would eventually explode. I was thinking of earthquakes, being a seismologist. Now, it turns out the two of us in this country that have gotten on this crowd effect in the markets bandwagon happen to be seismologists. The other guy's name is Dieter Sornet, who's a geophysics teacher, used to be at UCLA, he's now in Zurich. And it turned out we knew the same people. My professor knew his, I mean, we all knew the same people. He lived on the same street that my parents lived on. I mean, it's like, and we discovered this effect at almost the same time. It was like we were brothers when we got together. It was like, yeah, you found that? Yeah, when did you find it? Yeah, I found it then too. So this discovery of this crowd effect and how to measure it and how to find it in market signals was something that only a couple of people have been able to do. And I believe in 20 years it'll be in the textbooks, but we've got it now available on Alex's machine, on Bloomberg. And Sornet has got an institute in Zurich that he's running that tracks it. So what is this? So positive feedback, you think about an earthquake fault. I'm going to try to change the model a little bit here. How do you get an earthquake? Well, you have stress build up to the point where the rocks that are already faulted break. And they transfer that stress to the next area of the fault, which, if it's already stressed, might be just enough to break it, which transfers stress to the next area of the fault, which also then breaks, maybe, if it's stressed enough. So you build up stress, and then you add that one grain of sand, right? And it's enough to trigger an avalanche. And that's what happens in markets sometimes too. Actually, it happens on all scales. And it only makes the news when it's a big enough scale event. But you can build up stress even on 1-minute charts, and then you see a trigger event, and it cascades, gets to an end of the cycle, not enough stress to load up the 10-minute chart. You finish with that event, and then you build up, on a different scale. But we hear about it when the stress causes a big event on a large chart, like a weekly scale or even a monthly scale. So, the 07, 08, 09 period. So, one of my talks is entitled Financial Earthquakes because of this similarity. But, so how do we measure this? So, okay, if I'm going to say that fundamental valuation is akin to negative feedback and crowd effect is akin to positive feedback, great. How do we measure feedback? All we have is a market signal. We've got open, high, low, close every day and volume. How in the world are we going to measure feedback? Here's the answers to a couple of these. Negative and positive feedback. I'll skip this one too. So here is, this is a real chart. This is Home Depot from 1996 to 2013. The purple marks are valuations. And you can see the market got a bit overvalued here. And then down here it got a bit undervalued. Okay, well we talked about valuation. You want to be buying down here, you want to be selling up here. But we were also able to measure the crowd effect. And that's what these little marks are up here. This is we've measured the progression, an acceleration of price with these little cycles in here. We were able to measure that acceleration and identify it as a crowd herd movement and a positive feedback event that ended with this signal. So we threw off this signal in real time, saying, okay, that's the end of the trend, and by the way, you're very overvalued. Now, wouldn't you like to know that in your portfolio? We've got managers that take profits here. They can actually put an arrow right there at the top and say, oh, we're going to take half your position off. That's what this is all about. Every little basis point helps. And if you you know, you've worked your whole lives to put money into an account. You want to be sure it's managed with the best tools possible. Well, this is it. And, you know, finding the points where a trend starts and watching the progression of value up here, and then seeing it stutter and stop, and, you know, knowing that it's overvalued here, it's like cheating. It's like knowing, you're getting the answer, you know, to a quiz ahead of time. So, putting it all together, and this is a slide I guess is hard to see, but it's all stuff we've been over before. The fundamental value, we split the market dynamics into two pieces. Fundamental value, what's it worth? We get the valuation, we look for valuation trends that are going up, and we buy it at cheap. And then the crowd effect, we're looking for signs of feedback. Well, how do we measure feedback? We use something that's called the Hurst exponent for measuring feedback. You do not need to know what that is, but I'm going to give you an example of how it was created. The Hurst exponent was created by a guy named Harold Hurst, who was the engineer in charge of designing the Aswan Dam in Egypt many years ago, you know, maybe 100 years ago. And what he needed to know was the persistency of flooding in the Nile Valley, the Nile River Valley. And I dare say you guys need that here. Because what he discovered, the Egyptians kept great records. They had records going back centuries. They're an ancient culture, and they kept records because when the Nile River flooded, they could, you know, they had lots of water for their you know, needs. When they had droughts, they were in trouble. So they kept very good records, and when it rains, it pours. Basically, what they found is there were persistent trends in flooding and in droughts. It didn't just happen randomly. You know, if one year was a flood year, often the next year was a flood year too. I hope that doesn't happen here, by the way. I don't think it will, but anyway, I'm just saying that because this is what happened. And they had to build the dam taller because when it rained, it poured. They would have a number of years in a row of high river flow, and that accumulated over time, and they had to build the dam higher. So he invented, by analyzing the back data in the Nile River, he was able to create this tool called the Hurst exponent, and when the exponent was right in the middle, you had a random system. In other words, the river was the same, you got the same amount of flow, or, you know, random amount of rainfall each year. Couldn't put it wasn't correlated year to year. But in the green area up here, it was. If it rained, it rained the next year, it rained more the next year, it flooded more, you know, if it flooded one year, it flooded the next. He found that the real reading on the Nile River was up in here somewhere. So he had to build the dam higher. So why is this important for markets? Well, you've all heard people talk about trends. Well, how do you figure out if you've got a trend? How do you know it's not just random? That's what this will do for you. If you've got a trend, it will register up in this area. If you have, and I'll talk about the lower area in a minute. So instead of just saying words like momentum, which people love to use, this actually will give you a number. We can actually run this and get a distinct real number between 0 and 1 that tells us at 0.5 it's random. You get up above 0.5, we can tell that you've got a trend. Now, you get a trend in a stock. Why would you get a trend unless people are buying in a non-random manner? In other words, they're buying, it's going up, they buy more, pushes it up more, they buy more. So you're detecting some human involvement. And what I found was the discovery that Sornette and I made is that when you get up above a certain level, you get to an extreme where everybody on every scale, I mean, 1 minute day traders, guys that are looking at weekly charts, monthly charts, they all agree that it's going up. When everybody agrees, it goes down. So what we found up here is that as soon as everybody agrees that it's trending up, there's nobody left to buy. They've all bought. And so it corrects. It goes back down. This is the screaming end of the curve. It's either a major low or a major high, and it's very distinct, and it has certain characteristics, and we find it. Now, on the other end of the scale is what we call mean reversion. Now, mean reversion means simply that the market stays in a range, and very distinctly in a range. If it's been up for a couple days, then it goes down for a couple days, and predictably then goes up for a couple days, and then it goes down for a couple days, so the average stays the same. It's mean reversion. And if you were flipping a coin, the coin would be heads, tails, heads, tails, heads, tails, heads, tails. So it's very predictable. In other words, it's not random down in this area, in the blue area. It's very non-random. But in the very bottom end of this scale, you've got a tug of war between the supply and demand. Let's say you have a Fed number coming out, and all the different investment houses are placing their bets on what they think is going to happen. They are basically, some of them are saying they think it's going to go up, and some think it's going to go down, so they're in a tug of war. We light up with this when that happens. In other words, they are in a tension situation, and what happens next is you get a strong trend coming out of that. So by being able to determine the crowd, what the crowd might be leaning or doing or about to do, we can add to the value concept. Something's undervalued and it's about to start trending and it starts going up, hey, let's buy some. It's undervalued, it's got good valuation trend, the crowd has decided that they're fighting over it and they decide the buyers are winning, let's jump in and buy some. So by putting all these pieces together, we do a better job. And let's see, what slide was this? Oh yeah. So this is kind of a cool slide because we were talking over lunch about what about the whole market? What happens when you see the Dow going down hundreds of points, maybe 200, 300 points, you get scared. What's going on? Well, we can answer the big pictures too with these tools, because we can value individual stocks, so why don't we just take and value the top 1,000 stocks and then report every day how overvalued the entire market is? Wouldn't that be interesting? So anybody here remember 1987 crash? Okay, well, this graph down here is how over or undervalued the whole market is. The bottom is the overvalued, the top is the undervalued. So back in 87, it looks like nothing now, it was a disaster at the time, the market was overvalued by like 30%. So if you'd known this going into that peak, going into that period, you would have been pretty worried about your investments. Do I really want a 30% correction? Well, it actually went even further and corrected all the way down until it was fairly valued again. The black line is sort of, it's not quite zero, but it's offset a bit because the market discounts somewhat being the valuation. So it takes being 20% or more overvalued before it really kicks in. So the dot-com bust here, how overvalued were we? 36% overvalued going into that. Wouldn't it have been nice to know that ahead of time so you knew, I'm at risk? John and Alex have access to this now. They're watching this all the time. Back at the 07, 08 disaster, look, the top 1,000 stocks got to 40% undervalued. You could have bought anything. Just the time when nobody wanted to buy anything was the time to step out and you could just buy almost anything you wanted. And now, where are we? Okay, so the market's moved up. Valuations have come sort of back to normal. We're okay. We're sort of middle of the road. We're not way overvalued. We're not undervalued, but we're okay. So by watching this, these guys can do a better job for you. And this is another example. I've just put a couple examples in here. Here's a Mylan NV. Here's our valuations and the stock price. And valuations keep going up. The stock comes down. And then we get this little signal down here, which is the crowd effect signal saying that the trend down is over. And it's trading at, almost half, it's like half price almost. So why not pick up a little bit? It's not that risky right here. So this is what, Alex does every day for you and John. And they're looking at these numbers and working this a little bit. Is this the part you wanted to talk about, Alex? Or?
Well, I just wanted, this is supposed to lead into the risk management system.
Okay, well I can go over it with you.
Stocks, right?
Yeah, I mean, these are our crowd effect symbols up here on what they look like on Bloomberg. It's a little different on Bloomberg than on TradeStation. This is the 1929 top in the market, which is the granddaddy of them all. 1929, the market had rallied all through the 20s, the roaring 20s, and at this point people were leveraging their homes, all their money, they were going out on margin to buy stocks. And from October, and we got these signals saying that the crowd had run the stock market too far. This was the end of the trend. Now this is on a quarterly scale, and the effect of these quarterly signals will last for years. On that scale, they would last at least 10 years. It took the whole roaring 20s to build this signature. You can see the swoop up, the acceleration here, a few little oscillations along the way. That's the signature we're looking for. The end was there, and then you had all those years. It didn't bottom until 1932, and it went from $300 a share down to $42 a share, and you had the Great Depression. It wouldn't have been nice to pull your money out somewhere up here and not complain when it went a little higher. Anyway, what we're trying to do is provide these guys the tools so that you don't have to worry about your money. They're worried about it. They're watching it. They've got the tools to analyze what you're in.
Chris?
Yeah.
And maybe a question for Alex too.
Yeah.
Sure.
What determines how many stocks you're going to get into?
Well, he'll talk about that here in the next couple of slides,
Excuse
about
me.
the program itself,
Yeah.
how it's created. This part,
Well, the answer is sometimes there's nothing to buy,
right.
and that's when you shouldn't be buying.
And that's distinctly different than how a lot of people approach a strategy. In a typical mutual fund, there's two things they'll for sure never tell you what to do. They'll never tell you when to sell because they benefit from you being in that, and they don't benefit when those assets leave. So it's really not in their best interest intrinsically to ever tell you it's time to get out.
Yeah.
And for them, they're mandated by their articles of incorporation essentially to be fully invested to a certain degree. So
Yeah.
if they're looking at what to buy and they obviously don't use the same valuation methods that we use, and they say, even though everything's overpriced, well, let's buy the least overpriced stocks. You know what I mean? There's still a...
They're in a relative world,
Right.
so they'll buy stuff that's the least obnoxious,
Least
right?
worst.
The least worst.
Isn't necessarily the best.
And I'll tell you, it's actually worse than Alex is saying, because I've done a lot of consulting for institutional clients, and they have in their contracts often that they are not allowed to hold more than 5% cash. I had a manager for many years, had that written into his contract. You cannot, if you go over 5% cash, we will pull our money. And then it's $100 million at a clip. So they don't go over that limit. Now imagine that. If you're, let's say, a value manager as John is, and you're telling him, well, you can never go to cash. Well, you saw on that last slide, but there are times when you're way overvalued, you shouldn't be in anything really, or very few stocks. I mean, there might be a few, there's always something to buy, but there are times when doing nothing is really good, really good idea. And they're not allowed to. So these institutional guys, if you think maybe you're better off at a Fidelity, nobody from Fidelity here, or any of the big fund companies, we have Capital Group as one of our clients, and they're just always in. They can't pull out. So yeah.
But doesn't that keep it artificially propped up in the institution?
Yeah, well, how did that work in 07, 08, 09?
But I mean, as an individual investor, investor,
Yeah.
you can take advantage of that.
And why can't
You-
you allow it to go to a land trust?
Oh, you mean as an individual, you could pull your, yeah, you can pull your account out. But what I'm saying is the way the institutional space works is that the institutions that have the management duty get allocations of money from very wealthy corporations. Let's say Exxon, you're all familiar with. I don't know if they manage their money in-house or not, but they might hire a consultant to take your company money and spread it between several managers. Okay, and those managers are held to contracts where they specify that that money is yours as long as you stay within the bounds of your contract. And that could be no more than 5% cash. Okay, so you're over here as an employee. Can you pull your money out? Maybe you can. I don't know. But usually it's like once a year you can check a box or something that you want your money into some fund or not another. Anyway, sure, if you're an individual and you got a Schwab account or you put your money in Fidelity, you can pull it out the next day. That's fine. I'm not talking about that. A lot of times, though, these big accounts come over from big corporations and they're managed through a consultancy that then requires them to, stay to a little box. Your large cap value, well, here's your box, and you better stay in there. Even if your box is the very worst box you could possibly be in, you better stay there. You go out of your box, you're going to lose that $100 million. So it's been a frustration for me for years because, they're losing sight of your needs, which is, I don't want to be in if it's not the place to be, It's like this. So John has the freedom, and Alex has the freedom to say, market conditions are crummy, we're going to move a lot to cash, protect our investors. Our clients. So I think that's really good. So in terms of private investment management versus the big mutual funds, I think you're better off here, to be honest.
One more question.
Yeah, sure.
Is there an aspect of your program model
Mhm.
that factors in GDP and growth?
We have in each stock we have 3-month treasury rates and inflation. Those are the two factors that are the most important. Our earlier model had GDP growth, and it turned out the GDP growth was not that important a factor. The individual earnings growth and sales growth are important factors for the individual company, but not the overall GDP growth in the country. And we use this, the model now can run on any stock anywhere in the world. So we can value stocks in China. Bad idea to go there, by the way. It's 50% overvalued. And Europe, which is undervalued right now. So we can go anywhere in the world and look at what the stocks are worth. But those are the two factors that were the most important. 3-month rates. And I tried longer rates, 10-year rates and various things. And GDP growth and inflation was in there. So those two stuck. The artificial intelligence tool that I use actually throws out variables that it doesn't find important. It casts them out genetically. It uses genetic algorithms to cast them out. Yes?
About your comparison between the Dow Jones Industrial Average and the Dow Jones Transportation Average.
Mm-hmm.
Does it factor that into the divergence formula in there?
I have a good slide on that at the end.
Yeah, he's got a slide on it, but no, in terms of what we do, we're valuing each stock individually. Now, you could roll those up into a transport valuation, and we do this with ETFs. We can actually value ETFs and say which ETFs are undervalued or overvalued, because those are just portfolios. So the transports are a portfolio as well. We can value those, and I imagine you have done that.
I'll talk about it at the end.
So he's able to do that job, but in terms of the Dow theory, I think Alex is better to address that for you.
Can I ask one more question?
Yeah, sure.
What does it tell you that GDP is not a factor that's a relevant factor in this?
In the pricing of a single stock, it's not as relevant as some of the other factors, and so it drops it off.
I know, but what does that tell you as a person that's involved?
What does it tell me?
What does it tell
I've never really thought about it. I guess it means that the economy is diversified enough that even if the economy is soft, there are some stocks that are going to perform well and others that won't. And so it's not a determining factor on one stock's performance. Now, maybe over a whole sector it might be important somewhat, but you saw how those factors were diminishing down in importance, and 3-month treasuries were out near the end and inflation was sort of in the middle. Inflation's pretty important, but
But you were valuing 1,000 stocks at a time.
what's that?
You were valuing 1,000 stocks at a
Yeah, we value each one individually, then we look at the median of all those valuations and look at where that median
time.
is.
The process percentage of GDP is not relevant.
Not that important, no.
That's striking to me.
Yeah, go ahead.
So the GDP isn't that important? Well, doesn't that show how much disposable income a country or an individual has?
Well,
If you don't have
yeah.
disposable income, you can't buy or sell stocks.
Well, it might be important in crowd effect, but in valuing the individual stock, you're kind of far removed from, an individual business is kind of far removed from the GDP growth of the country. It's going to be more sensitive to, I would think, inflation and interest rates myself. And interest rates have to be a part of the equation because you're competing with fixed income when you're talking about stock growth. Don't know, but it dropped it off. I had it in the original model because I thought it was important, put it in, and didn't let the modeling tool throw out, this was back in 2000, didn't let it throw the factors out it didn't like. But now with the latest versions, I've let it throw out the things that it didn't find that useful, and it threw that out. So.
Even with income growth per household less than 1%, that shows how much money people have to spend.
That's true. But the value of a company is not necessarily the same as the amount of money people have to spend, because they might spend it on, say, healthcare. Not that that's going up fast. Anyway, here's, we talked about 1987, and I showed you how overvalued it was. The top in 87 was 30% overvalued on the top 1,000 stocks. Well, we also got a crowd effect signal up there. So those two factors together, had you known that at the time, you'd been running for the hills.
Yeah, I lost money asking me, so.
Yeah, a lot of people did. It was a scary drop. And, to see this, made me feel really good that the model was actually picking up on this, again, this acceleration up with these little oscillations in price that you see here are predicted by the model that we discovered. They're called log periodic cycles, and they're there. And they're just gorgeous. They fit exactly with the theory. In fact, the rank on here was a 90, I can't tell if that's a 99 or a 90. Yeah, it's a 99. 100 is a perfect fit to the pattern that we're looking for. So it was, and this was a quarterly scale. So this effect would last 7 or 8 years. So it was pretty strong. And, with the aim being that not every signal works, and nothing ever works all the time, but if you have the ability to see these, you've got a little bit more firepower. We've got a little bit of an edge over what other people are doing. So we've got a better chance of coming out ahead. Okay, so this is more what John's doing. His universe is top 1,000 stocks. Now you're going above 20 positions now, right? Is that the idea?
Yeah.
Yeah. We're looking for low volatility stocks that are, everything in the top 1,000 is going to be liquid, price above $10 a share, persistent 3-year valuation uptrends. We want those valuations to be going up nice and smoothly. That shows the management is running the company well. And we want it to be undervalued by at least 30%. This is the recipe that we're using here at JCN. And we want the prices to start rising a little bit. We want them to have turned the corner, show some signs of strength. And what strength looks like is volume goes with price movement. So when you see volume increasing with the price going up, that's good. Volume decreasing with the price going up, not so good. We want to see volume expanding with price movement upwards. And there's a number of pieces that other people have done and myself proving that that is very significant. You want to see volume confirming. Let's see, excess cash that they've got here will go into an ETF that happens to be undervalued, or it'll just stay in cash if the market's overvalued. There's nothing to buy. No margin, and the computer that's sitting on Alex's desk has all this on it. So, you could individually, you come in sometime and look at some of the charts and enjoy looking at some of these techniques working. We've got a risk management system that's based on probabilities. That's what's responsible for targets and stops that Alex tracks on the computer. Here's our valuations, and here's our targeting area, and our what happens if we're wrong. Recommended stop prices. So we've tried to cover all the basics. So the tools are here for your professionals to handle your portfolio as best they can. And I think that's about, you were going to talk about this. Yeah.
As I do all meetings, I'm just going to do a brief market update. A lot of the challenge, for me is, he focused on the media really sensationalizes what's going on. Sometimes they don't even really have the right data, and they make money from ratings. So a car accident is much easier to get people to watch than something nice. And so what I like to do is just focus on some key data points I think are relevant to think about, and things that I'm taking into account when we're looking at the kind of next stage in our strategy. One of the things I talked about in the last meeting was, what the view on is with the election. Now, without getting to each party or which side should do better or worse, one of the things that I pointed out was that there's an interesting statistic that we found going all the way back to 1928, where if the stock market is up or down going into the election, just by any amount, it has been in the past very, very accurate on predicting who won the election. So, for example, in this model, if the market was up by any amount from August to November, it usually predicted the incumbent, which would be the Democrats, winning the election. Now, this has been accurate 86.4% of the time, which, according to all the polls I've seen, is a much more accurate model than really what's out there. So currently the S&P is down very slightly, 1.7%. So at this time it is pricing in a potential Trump victory. Another thing that I thought was interesting was that there's these other scientific models that are not based upon polling that have also predicted correctly the election the last 5 times, one more specifically by a professor in Northpot. And he has Trump winning by 87%. So I'm not trying to sway votes either way, but these are some things that we are taking into account just because both policies can have a different effect on the market. This one poll I thought was interesting just to add, just because it was very accurate in the last election. It's got it almost tied, so it's very close right now. The very first slide that I showed was just to give some perspective on where we are in this bull market. Just to kind of understand, what could be expected to happen next. Right now, we're actually in the 3rd longest bull market, so it's been going up without having a correction to a certain degree for a very long time, the 3rd longest in history. But you can see it's not really the highest. It hasn't moved up as much as it has in the past. So to me, statistically, there is still room to run here, and that's really what we're kind of keeping monitor of. Say if this started to take off and started to get statistically very far or very long, these are things that would change the potential position of the portfolios. Just for a view of where we are today versus in January when I moved down here, is we've really been just continuing to go sideways. The S&P is only around 1.5% above where it started in 2015, so the market's kind of been still healing itself and getting its footing here. It's actually exactly where it was at the all-time high today, and it's only around 3.5% above the beginning of 2016. So
Hey, Alex, you
yeah.
might also point out those little tick marks show the valuation
Right, so this is the actual value of the overall market. So the one thing to
of the S&P 500.
this is actually the Russell.
Oh.
But you
Okay.
can see here they
Sorry.
were going up, and then as they started to flatten, again, these don't know about price. They're completely independent from price. The market actually went sideways as this also went sideways. The one little cautiously optimistic positive note here is the last 3 months we've seen a nice jump, so meaning the market itself is becoming more profitable, and that the valuation this month had a new high. So there's some strength there. It's not quite, accelerating, but it is showing some positive signs of going forward. Now, why is this happening? In the first presentation, I showed that a lot of the damage to the earnings and whatnot is really focused in the energy market, and the good news is it's almost in the black. So we're watching these numbers come in, and you can see that we've kind of passed the 0 point here, where a lot of these companies were facing, bankruptcies and just financial troubles. And as of this quarter and the forecast out, it has this sector, basically starting to go profitable again, which the energy sector is a significant part of the overall stock market, and that could help.
So this energy issue with the bankruptcies, blah, blah, does that have to do with the price per barrel?
It absolutely has to do with the price per
Just
barrel.
check.
Yeah, no, that's.
Whatever this thing that you talked
Yeah.
about, when you talked before, I wasn't here.
A lot of companies, their break even was $85 or $75, and so sustained low prices. They've had to shut down pumps, and that's a long process. You can't just shut things down. Like, you shut them down, they're going to stay down for quite some time, and the price of oil needs to sustain over $85, actually $65 in a lot of cases, for them to even consider getting all these jobs back. So, that's just one thing we're really watching, and you can see that it's starting to improve. So, these are things that really happen. They're not, predictions. This is what's going on today.
According to today's paper, OPEC decided on 50 for the rest of the year.
So,
So at least Louisiana will bring
at least there's something there. The one bright spot I do want to kind of show is without energy. If we just took out energy from the stock market and just looked at it, pretending it didn't exist, the market itself actually did have growth in earnings 4 out of the 5 past quarters. So you can see it's not a total market issue, at least in the numbers. It's really been, at this current time, kind of an isolated thing. These are forecasted numbers outward. They're not definitive, things that have happened, but it is looking cautiously optimistic, like I mentioned before. One of the things that I think is interesting that will potentially help move through the inventory is that Chinese auto sales just hit an all-time high. So there's still 1 billion people in China who have yet to buy a car, and that, I think, is going to, you're going to see that, going out into the future. It's kind of a lag effect, but that is something that I'm looking at as far as in the oil situation. The other thing that I look at very closely, because we do hold a fairly large amount of bonds in our portfolio, is inflation. This is something that the Fed really tries to target, this magic number of 2%, and the blue line is what's called core, so that's like what's normally reported, but headline does not include food and energy. I don't know why they do that, because we all use food or energy, but they're just trying to get a feel on what prices are going up. And you can see this is starting to go up slowly, and the kind of Goldilocks number is 2%. That's actually historically when the economy actually starts to feel in the kind of the sweet spot. So it is improving slightly. If inflation starts to go down very drastically, that's deflation. That's something that's more of a danger to us. So we're watching that improve slightly. So as we look forward at what to add to the portfolio as opportunistic wise, what are the leading sectors? Because as Chris showed you, we can look at what's starting to earn more than the other sectors. And right now, what's leading the way is the financials. So you probably noticed a couple of trades we made in the last few months. We bought US Bancorp, which is a capital market stock, and we bought Prudential Insurance, which is a best of breed insurer. And this is really from these numbers that I'm showing here. We also have Ameriprise, which is a financial services, but this is sort of on our radar right now going forward as additions come into the portfolio. I wanted to add this slide just for you because you asked me about the Dow theory. The Dow theory is a technical signaling strategy where in the past the theory is, if the industrials, which represent producing goods, are not in line with transports, which transport the goods that were produced, that usually was a sign of weakness in the market. And over the last few years, this has actually been kind of a prevalent thing. A lot of technical guys have highlighted. And currently, if you go by the rule book, it's in neither a good or bad spot. It's actually called a initial signal. So if you were to have both the index of transports, which is railroads, nowadays the airlines and shipping companies are more of that than they used to be, when they're both reaching new highs together, that's actually a traditional sign that it's all clear ahead, blue skies ahead for a high or bull move. Now, when both of them break down to new lows, that's actually when the warning signal or the signal to sell traditionally is exactly. So you can see we're right in the middle. Yes, the transports have been weaker relatively to the industrials, but to me, this initial strength, all it needs is the transports to really get that bump up, and then that also will be a signal for a new bull move traditionally. So I just wanted to address that last chart because I do follow these models. They're somewhat antiquated because how the economy has changed over time. They're not as accurate, but this is something that I do follow.
We going to include drones?
That's sort of the hands-on play. So just to leave you guys with the data I'm looking at so that you can go home and kind of soak some of these things in. The data objectively is cautiously optimistic. I think a lot of times you get people hawking fear over the radio or TV because they got something to sell. They got to sell you gold, or they got to sell you ammo, or they got to sell you something because they're creating a problem for you. And it's really not quite that clear in the data. Oil prices rising will help, and you can see that in some of the slides. Right now, I don't see too many major threats. A lot of times it's the thing that you don't see that is the next problem. But we seem to have made it through this year with that oil contagion pretty well. A lot of stocks that aren't really related to oil got cheap, and we bought Apple computers, which really has limited exposure to oil, and we've seen nice gains there. And the recession predictors that we watch are actually quite low. So we look at a multitude of different models that monitor the unemployment rate, productivity, inventory orders, like all these things that come into this model in a raw form, not in a model form. And to me, they're not really signaling high probability of a recession right now. Now, typically, they try to pump those numbers up political-wise going into an election, so who knows how those numbers will kind of come after. But right now, interest rates are rising a little bit, and I think personally, if they do rise slowly at a moderate rate, it's actually a good thing because zero interest rates isn't a normal event. It's that normal 5 to 7% interest that historically has been a good thing for the economy. So. With that, I want to just thank Chris for coming up. If you guys have any more questions, yes, go ahead. Sorry.
That's all right.
We love questions because this is what we're here for.
Brexit factoring into anything at this point?
What's that?
Is Brexit factoring into anything?
I haven't really processed many stocks from Europe lately. I imagine it'll be in the stock prices in the UK.
Siemens?
What's that?
Siemens?
Probably, yeah. I mean, we can run the model against any stock anywhere. So,
I'm wondering because that was a pretty curious event.
yeah. Well, the last time I ran the model on Europe was about a month and a half ago, and it came out green all over Europe. In other words, being fairly undervalued. And the crowd effect models are showing a nice new trend starting on sort of a weekly scale, which the Stoxx 600, the CAC, and the DAX were both showing some nice movement upwards, and they're undervalued. So Europe's looks pretty favorable right now. China looks very overvalued. I think Japan was undervalued. US is just, like you saw, just marginally overvalued, just a little bit, nothing to worry about. Where else have we seen
Since you
valuations?
were here in the first presentation I gave this year, I actually showed which countries are stimulating, so their
Yeah.
central banks are enacting repurchase agreements, and right now the European government has the highest amounts in the ECB, and that's really the effect of trying to soften their weakness in that economy. So the Federal Reserve, from all the data I see, isn't stimulating as much anymore. They're kind of on a hold, but in Europe they're doing that quite drastically still. So
Yeah.
that's why I think a lot of the troubles there are starting to subside. Brexit really was a currency situation.
Yeah.
It was where overnight they thought they would vote no, and then they voted yes.
Yeah.
And none of the banks ever expected that to happen. So the British pound moved way more than they ever historically expected it to move. So what was interesting is it was a one-day event, and at that time we were still kind of in a quasi-safe position in our models. We actually had a huge amount of cash, so it didn't really register for us in any meaningful way, which is
surprised
interesting.
that it didn't affect the markets here as much as people had thought it would.
Yeah, I think it was a shock, and then people go, well, what do we sell Britain? Nothing.
Yeah,
And then what do they sell us? Almost nothing.
Yeah.
So it was kind of a one-day.
I make my own lemon curd. You know, I don't need to buy it from London.
So thank you for
Anything else?
Appreciate it.
How about the German banking problems they had? They're still in problem, still have it. How can Germany be looking positive with their banking system?
Yeah, no, they're trying to work through it. Deutsche Bank
Can
just
they actually finance themselves through it?
they just made a deal with the Saudis to get a capital injection, and so to me it looks like they're doing everything they can to not have to declare bankruptcy on Deutsche Bank. Deutsche Bank again used to be an arm of Bank of America, and goes all the way back to the Bank of Italy. So it's a very old institution. To me, it seems like they're doing what they can to save it. But as far as how it would affect our portfolios, objectively, the U.S. banks, which you can see are starting to get more profitable, it's actually kind of winner take all from that situation where they're losing because their interest rates are negative. So our banks, money just flows to where it can get the most interest.
Yeah,
And
most
we're
return.
actually seeing that in the numbers are benefiting.
But our process
Right.
doesn't involve how I feel about this,
Right.
or what I think's going to happen, or what should happen. It's not part of our process.
That's what the machine says.
It's a mathematical process. And so by taking that emotion out of it, you're able to make more clear-minded decisions. The world's going to continue growing. There are more people eating on this earth tomorrow than there are today. We're going to have growth. It's going to happen. So we don't look at it. It's a mathematical process. And I think that we started implementing Chris's technology back April 8th. And it's very preliminary, but we're very, very pleased with what we got from it in an extremely short period of time. So the question as we wrap this up would be, how many people that came tonight are going to leave here knowing something and didn't know before they came in?
Yes.
So, and Chris is out in Washington State. Anytime you're down this way, we'll try to harangue you back over here to get
Yeah,
here.
no, we'll come down again.
We'll do an end of the year market update. Alex probably do in December. We'll have something again in November, the presentation in November. I'm doing something personally as well, but some of you may want to participate and help me a little bit. I wrote a book here recently. It's published tomorrow. I've got it on Amazon, and I was picked by a publisher. So in 3 months' time, they're going to publish it in a bigger way. But what I'm doing is I'm doing a series of little presentations with the book's about. It was past week. I'm doing another one on Monday the 7th. If you're inclined to participate, you come in this room, I'll give you kind of an overview of what the book's all about. It's called How to Live the Life You Yet to Dream. And it's something that I've done all my life. I've put together, and it works very, very well for me. I came from what you'd probably consider a very difficult childhood, and I had just a wonderful life. I had a great childhood and a much better adult life. And I wrote the book because of Alex. For about 6 to 7 years, I've had employees saying, John, you should write a book, and that went in the left ear, and out the right ear. And in January, Alex says, John, the second time we go to lunch, you're all writing a book. So I started thinking about that, why is somebody telling me to write a book? And then it occurred to me that if I took time to do what I didn't want to do, which is write this book, I might really be able to help people. If you look as you come in this room, there's a sign that says, enabling people to have a life they otherwise wouldn't have. So I've used my business as a way to do something really my own personal needs. So as you come to me as a client, you're coming to a typical client relationship, but I always look at something different. Every single one of you, when you came in, you thought we just had a business relationship, and we did. But I grew up in an environment where I know what it's like to need help and not have it. So, to that end, the book's available on Amazon right now. You can go type in How to Live the Life You Get the Dream, it'll come up, or you can do John Nealon, it'll come up, or you can buy one from me. They're $16.95. I donate every penny to the nonprofit I work with. So I've been doing this nonprofit for 17 years now. And I'm going to be going out next year as a paid speaker around the country, speaking to corporate groups about the story in the book. And I'll hope to get donations and other support from there as well. So on your evaluation form, you should fill that out. If you would like an invitation to Monday the, I believe, 7th, just put book on the form, and Leanne will reach out to you. We're going to have probably 20, 25 people. If you come, we're going to ask you to bring a stranger with you. Because if you know me, you're more than likely going to see it differently than somebody doesn't know me. And as you have investment questions come up, don't ever hesitate to ask us. We'll give you the answer. It may not always be the answer you're looking for, but it's going to be one that's a mathematical, logical answer. And you know, I often have clients come say, "What do you think about it? How do you feel about it?" Every time I hear that, I'm thinking, "I don't think and I don't feel." And it gives me great peace. It gives me great peace to go through the marketplace doing that. The Wall Street sells stocks differently than the way you buy them. They're looking to sell it there. Chris built that model. Did you tell him about the price wizard? How you built the model, and they want to sell it. They sell a stock at 50, and Chris says it's worth 30. And after he did that, said, "Fine, we don't want your model."
Yeah, I know.
But thank y'all for attending, and please give us your comments and evaluation form, and we'll have no speakers in November and no one in December as well. Thank you.